Hello, and welcome to Chart Talk from JAG Capital Management. Chart Talk is a periodic look at financial markets and economic developments using charts that make a point. Our goal is to give you timely, quick hits in a world where information overload is a daily challenge. I'm Mike Buck, an analyst at JAG Capital, and I'll be your Chart Talk host. In this installment, we're going to look at where sector weights in the S&P 500 are now and how they have evolved. We'll finish with a sector that will be worth watching in the months ahead. Let's flip some charts. If you follow the financial press, you probably already know that the tech sector's share of the overall S&P 500 index has been steadily growing and as of the end of May stands at 38.5%, as we see in the pie chart. The financial sector is the second largest with a weight of 11.3%, followed by communication services at 10.4%. This leaves about 40% for the remaining 8 sectors. On slide 3, we track the weight of the tech sector by itself, beginning in March of '79. Tech closed the 70s with a weight of 10.5%, dipped a bit during the recession in the early 80s, then rose to 12% by September of '83. Despite the introduction of mass-market desktop computers, tech's share of the index fell by more than half during the 1980s, from 12% in '83 to a low of 5.6% in Dec of '92. The 1992 low set the stage for a run that ended with the peak of the tech bubble in March of 2000, with tech's share of the index at 32.5%. During the ensuing bear market, tech's weight declined to 13.6%, a level that has not been seriously challenged ever since. Any setbacks along the way have been temporary and followed by new highs. As of May 2026, tech's share of the S&P 500 stands at the aforementioned 38.5%. The table on slide 4 shows the top 10 holdings in the S&P 500 at the end of May. Note that following a reclassification Standard & Poor's implemented in 2018, companies like Amazon, Alphabet, Meta, and Tesla, which had been in tech, are now in communication services and consumer discretionary. Despite the sector reclassification, Amazon, Alphabet, Meta, and Tesla remain members of the Mag 7 in good standing. With that in mind, we move to the chart on slide 5, where we show the combined weight of tech, communication services, and consumer discretionary versus the remaining 8 sectors. For most of the roughly 46 years covered by this chart, the weight of the 8 sectors, represented by the red line, thoroughly dominated the weight of the tech, comm services, and discretionary trio. There was a brief exception in March of 2000 at the tech bubble high, but that was quickly reversed as weights reverted to pre-bubble levels. But beginning in 2008, we have seen an almost uninterrupted shift in sector weights favoring tech, comm services, and discretionary, at the expense of the remaining sectors in the S&P 500. As of May 2026, tech, comm services, and discretionary make up an unprecedented 58.6% of the index. The tables on slide 6 provide more details about the dramatic shifts in sector weights over the past 18 years. The table on the left shows S&P 500 sector weights in November of 2008, while the table on the right shows the current sector weights as of May 2026. November of '08, May of 2026. As a quick aside, I want to point out that Standard & Poor's retired the telecom sector in 2018 and replaced it with the communications services sector as part of a larger realignment, which also saw companies like Alphabet and Meta leaving tech for comm services, while Amazon and Tesla moved to consumer discretionary. In any case, the revised sector lineup is incidental to the overall shift in power towards technology and tech-related companies and away from virtually everything else. Note in particular the precipitous declines in the weights of energy, 14.4 to just over 3%, consumer staples from 13.1 to 4.5%, healthcare from a little over 14% in '08 to 8.3% currently. The S&P 500 and by extension the entire U.S. economy looks vastly different today versus what it looked like less than 2 decades ago. I want to finish by taking a closer look at the healthcare sector. Slide 7 shows the sector's weight between March of '79 and May of 2026. There are some interesting points to make about the chart. Note, for example, how healthcare seems to have a hard cap at just under 16% of the S&P 500. Healthcare almost reached 16% in September of '01, January of '09, July of 2015, November of '18, and December of 2022, before falling back each time. The latest pullback from the nearby high in December of 2022 has seen healthcare's weight plunge from 15.85% to only 8.3%, a 33-year low. One wonders if the high level of regulation and government involvement in many aspects of healthcare end up creating a de facto max weight for the sector at the 16% level. Just a thought. It will come as no surprise that changes in sector weights are related to relative performance, a fact illustrated on slide 8, where we show the performance of XLV, the healthcare ETF, versus SPY, the S&P 500 ETF. Once again, we see that healthcare has had a particularly rough ride since December of 2022. The waterfall decline in healthcare's index weight is closely mirrored by a similar plunge in its relative performance. On May 11th, XLV made an all-time relative strength low versus SPY. Looking at the performance of individual names shows how rough the last 3 years have been for healthcare. Between December of 2022 and May of 2026, SPY rose at an annualized rate of 23.7%. Only 3 S&P 500 healthcare constituents, Lilly, Cardinal Health, and DaVita, outperformed SPY over this interval. The remaining 58 healthcare names all lag SPY over the last 3.5 years. My takeaway from this review is that the market is constantly evolving. Tech and tech-exposed sectors have dominated the performance rankings in recent years. However, there is no guarantee that will always be the case. Even if tech continues to perform well, it's likely there will be times when investors look elsewhere for attractive opportunities. Healthcare and other sectors that have badly lagged the broad index could benefit if tech takes a break. That wraps up this installment of Chart Talk. Thanks for watching.